Welcome to the UTI Swatantra series powered by ET Now. I'm Faye D'Souza. In our continued effort to help you understand your finances better, help you understand mutual funds better, we have a special episode for you. On this episode, we're going to talk about different asset classes and how you can access all of those asset classes through mutual funds. As always, I have an audience in the studio who are going to ask questions and a panel of experts who are going to answer those questions. I'm going to do a quick round of introductions to those panel of experts. Ganesh Shanbag is the owner of SMS Financial Services. And Anandbir Singh is an independent financial distributor. Gentlemen, thank you so much for coming in. I'm going to ask you, an obvious question that I know a lot of investors have. Normally, we assume that all mutual funds are stock market related, which means they're subject to market risk or they're equity linked. That's not true. There are various asset classes I can access through mutual funds. Tell me, what are the asset classes available other than equity?
What we forget is instead of a bank fixed deposit, you have a bond fund. For short-term money, you have a liquid fund. And for gold, instead of having it in physical form, you can have a gold fund also, other than the equity funds. So this actually covers most of the gamut of funds.
Tell me how a gold fund functions. I mean, for all investors watching right now, we know how we buy gold. It's a fairly easy transaction. You go into a shop, you buy some gold. How would a gold fund function in that case?
If you were to buy a gold fund, automatically when you invest that money into a gold fund, the fund house will automatically go and buy gold worth that amount, that value, and keep it with a trust where it is secure. So whenever you need the money in future, let's say if the gold price moves up and you need the money, you can actually go and redeem the gold fund, and the price of gold at that given point in time is what you will get over a period of time.
Right. Well, Anand, tell me about the debt funds. Now, normally if I want a debt investment as an average investor, I will use either a recurring deposit or a fixed deposit or one of the government bonds, like the National Savings Certificate.
Right.
How is a debt mutual fund different or similar to these, and in what cases should I be using them?
So you have a wide variety of debt funds, starting from a liquid fund to a fixed maturity plan or an FMP, and you then have the income and the gilt funds. And over the last few years, a new category has emerged, which is the accrual fund. So the liquid fund is typically used as a parking lot, for really short-term requirement. The FMP is for...
So when you say short-term here, you mean
it could
a
mean,
month, 2 months?
Yeah, it could be about 1 to 3 months. The FMPs for traditionally the fixed deposit investor. Again, now with the new tax, you have to be invested for 3 years in order to get the long-term capital gains benefit. The income and the gilt funds are for someone who wants to take a call per se on the interest rate movement. And the accrual funds are again ranging from 1 year to 3 years. And they basically accrue interest, and also because of the maturity that they hold, you can get a little bit of a capital gain depending on the interest rate movement. So you have a lot of options even in the debt space.
If I'm going to give you a really challenging question, since
Okay.
you did such a good job with explaining those investments. There are a lot of bankers right now who call clients and say, listen, you should consider arbitrage funds.
Yeah.
Instead of using your fixed deposit. It's a
Right.
much better option. A lot of times these people are unable to explain what an arbitrage fund is
Right.
and how it works, because technically it's an equity fund.
Right.
But it gives returns like a debt investment. So for the benefit of those watching at home and
Right.
in the studio, how does an arbitrage fund work?
So I think an arbitrage fund is a parking lot plus, if you want to call it that. The taxation is equity because the underlying asset is an equity asset, but there are no open positions taken, meaning if I were to explain it to a layman, I mean, you're buying the same asset on 2 exchanges at the same time. So you're not really buying and holding, you're not taking delivery of the asset, which is why it's considered a safe, liquid kind of, well, I won't say safe, but relatively safe investment where you can keep your funds parked for about 3 to 6 years. Would I compare it to a fixed deposit? I don't know. Obviously, the risk is something completely different. Also, what's very important in the arbitrage fund is you have to understand that the arbitrage opportunity is not always available. So these funds will do well in volatile markets when conditions are suitable for arbitrage opportunities, but otherwise they come back to liquid fund kind of returns.
Ganesh, tell me this. I know we have a few senior citizens who are watching here right now, and those are the ones who tend to avidly invest in debt products. So whether it's a fixed deposit or it's a debt mutual fund, what advice would you give someone who's traditionally been a fixed deposit investor? So I use FDs because I understand how they work. I understand the taxation. It's not complicated. I know the guy I go to in the bank and we manage to do this. It's very simple for me. Why should I shift to any other form of investment if I'm so comfortable with an FD right now?
I think traditionally we Indians are used to the fixed deposit psyche. It's a mindset actually. And more than that, I think everybody wants a regular income. I don't know why, but we feel nice when you see an entry in your passbook. But we fail to understand that there is an underlying tax that is deducted. So actually when we look at returns, we should not look at just plain vanilla returns, but we should look at tax adjusted returns. Supposing a bank is offering you an X percentage interest, you have to deduct tax on it. And ultimately your return is post-tax. Whereas a debt fund today is giving you a similar return like a bank deposit. Actually, it gives you more than a bank deposit if held for a period of 3 to 4 years, which is a typical fixed deposit mindset.
Of course, you can't guarantee more than a bank deposit, can you?
Around or more than a bank deposit. Typically, we've seen that, if interest rates were to rise, then there is a problem. But if interest rates were to come down, which is, we are looking at, then probably it gives you more than a bank deposit. But the major advantage is there is no TDS and there is no tax on a bond fund if you hold with, as per the current tax laws, of more than 3 years. Now, typically in a fixed deposit in India, people put a fixed deposit for 3 years and keep renewing it every 3 years for the next 6 years, 6 times. So typically you hold on to it for 18 years in a fixed deposit. So it's more psychological, I think.
All right. Let's open the floor up for questions. Is there anybody with a question? Yes, go ahead, sir.
Being a senior citizen, I would like to have your advice whether we should go for debt fund or equity fund. Number two, what would be the investment horizon for senior citizen in both the cases? And what would be the tax implication in both the cases that will be applicable? And whether I should go for growth option or dividend option. Thank you.
Actually, I'm going to ask you one more question before I ask our guest to answer. The money that you're going to invest, which you're asking about, what is this money for? Do you have a plan for the money? Do you know what you're going to use it for?
Regular income.
You want a regular income. So for someone who's generating a regular income, Anand, if you want to take this, equity would not be a very good way to go, would it?
Well, it depends now, on your time horizon. I think the safest and best option would be to be in a debt fund. Though you have to understand that you have a very long time horizon to be in a debt fund, because interest rate cycles don't take 10 years to play out. So you could be on the wrong end if you're in a debt fund for a 10-year period. So either a combination of both, or you have this new breed of funds that have come out which have equity and debt, and they are tax efficient in terms of dividends that they give out, because 65% of the portfolio is in equity and equity underlying assets, and 35% is in debt. So even out of the 65 in equity, 35% is in arbitrage. So it's a combination of both. Having said that, I think given the fact that you're a senior citizen and you are relying on a steady income, I would stick with a debt fund. And if you could wait 3 years, the growth option, otherwise the dividend payout option.
Ganesh, if you want to weigh in on this, one of the other options for the gentleman is use the senior citizen savings scheme to generate that monthly income, and then invest in a balanced fund to beat inflation over the long term and to sort of manage to top the inflation.
Something like that, as you said, rightly, it could be a combination of a debt fund and a balanced fund. The balanced fund probably is the equity flavor for you. 100 minus your age should be amount that you should invest in equity, basically. Worldwide, that's a thumb rule. So you deduct 100 minus your age, that is the equity exposure that one should have at any given point. We come across many people who say, I'm 85 years old, I don't want equity. I'm sorry, if you have to beat inflation, some amount of your entire wealth has to be in equity to help you beat inflation.
And what would be the expected return on my investment in debt fund and equity
I think typically a balanced fund would give you a return of 12% safely, which is tax-free, so that should be the overall return that you should be looking at.
Okay, thank you.
All right, we're going to have to take a very quick break, but we come back, we'll also talk about equity mutual funds and those very interesting balanced funds. That's on the other side. Don't go anywhere. Welcome back. You're watching the UTI Swatantra series powered by ET Now. Thank you for staying with us. We're talking about various asset classes that you can access through mutual funds. We talked about debt and as an alternative to the average fixed deposit that you and I like to use. We're also going to talk about equity funds, but I would like to work through some of the questions we have. Yes, go ahead.
Sir, my question is regarding liquid fund. Like as you said that FD is the traditional way of investing. Now suppose if I have a say time frame of say 3 to 5 months. Like in FD also what interest we get is taxable. Even in liquid fund, the amount which I will get will be taxable, I think, if I have a horizon of 3 to 6 months. Shall I go for liquid fund dividend option to get rid of that taxation part? And how much return liquid fund gives for say around 3 months? If you compare with FD and liquid fund, say for a 1 lakh rupee for FD 3 months and liquid fund 3 months and any liquid fund. And what option should I choose?
Can you actually get rid of the tax?
No, so that's my first point is that you're not getting rid of the tax.
If I put in dividend...
No, the tax is deducted from your return. So the mutual fund is paying the tax on your behalf. There's something called the dividend distribution tax.
Oh.
So you're still being taxed, but you don't physically have to pay the tax. So I don't think you're getting rid of the taxation. I think a very important point that we are missing in the mutual fund is the liquidity. So after 3 months, if you're in an FD, if you have 100 rupees invested in an FD and you only need 20 rupees of that, you have to break the entire fixed deposit. In a liquid fund, you can play sum and parts, you can invest a little more, you can remove a little more. So I think that's also an important aspect to consider. I think post-dividend distribution tax, again, the option you choose would depend on your tax bracket. But if you were to be in the dividend reinvest option, I think post-tax between 5 to 6.5% is a fair expectation.
Yes, go ahead.
Wanted to know whether there are better returns when we invest into a mutual fund or when we invest into equities of A-grade companies.
So
actually, to be fair,
Yeah.
let's compare apples and apples here.
Yeah.
He said, A grade, you said. I'm not really
A-grade
sure
companies.
how you're measuring A grade,
So,
but let's take
I
blue
mean, which
chip
are
to
blue
blue
chip kind of,
right,
yes.
so if you look at the mutual fund returns as a category, the large cap or the diversified category, and compare it to the index, which is typically your A-grade companies, you'll see that most fund managers have outperformed the index. So even if you were to basket the index and buy it as your A-grade companies, actively managed mutual fund, most of them are still outperforming the index. So I think, I mean, if you were to also in terms of the risk, you're in a diversified portfolio. So with 1,000 rupees, you can buy 40 companies. Whereas if you were buying A-grade companies with 1,000 rupees, maybe you couldn't buy 10 of those A-grade companies. So I think the diversification also reduces the risk.
Okay, the gentleman behind you has a question.
What I want to ask that if you select a fund, there are two options, dividend and growth. In case of equity, those who are traders want to sell buy share and sell it at 3 o'clock. We can't do something like that in mutual fund. You have to invest for at least few years or few months at least. Now, if I want to take a best possible mutual fund, now my question is, which is the best option, dividend or growth for the same mutual fund? Let us compare apple with apple.
Right.
So what is the benefit by, I don't need money now, But still, shall I go for growth option or dividend option?
Actually, you know, the interesting part of that question in all of it was, I don't need the money right now.
That's what I said. Actually, in India, we are psychologically tuned to seeing money coming in into our passbooks.
Yes.
I don't know why, but we feel very nice when you see that entry there. And we actually don't need it. And after 3 months, you'll say, oh, I have a decent balance. I want to reinvest that money somewhere. But we fail to understand that there is something called as dividend distribution tax that is being deducted when you're getting the dividend. So why do you need that dividend in the mutual fund option? I'm of the opinion that if you take a growth option and you can do an analysis, backtrack it over the last 10 years, if you were in growth, your returns would have been better than you were in dividend, other than the psychological factor. If you really need cash flow, then take dividend. If you don't need it and you're a long-term investor, let it be in growth.
If I have some growth option, I have some dividend option. Can I change the dividend option to growth option?
Yes.
So if he has a dividend option mutual fund, he wants to switch it now to a growth
So you're
option
right.
mutual fund.
It will be.
What's the procedure?
So you given a change of option request form, it will be looked at as a redemption and a fresh investment. So for your accounting purposes, your date of investment will be the date the fund got changed, and when you sell it off, those are the taxes that may or may not apply.
If it is, I'll just add, if it is more than 1 year, it is an equity fund, it is long term. So after 1 year of investment, you can shift it. There is no tax liability for you.
All right. You know, the other thing that we should consider, Anand, if you want to look at this, is if I have a mutual fund, now, unlike a fixed deposit, what happens is that dividend option money comes into my normal bank account, which is the bank account linked to my mutual fund. And it might be 500 rupees or it might be 1,000 rupees. It sort of just gets lost in your daily expenses, right? That money just floats away. There is the opportunity loss because it doesn't feel like a certain amount of money. Whereas when the money goes back in a growth option and gets compounded, something really beautiful happens to that investment where over a longer period of time, it really begins to make a difference. So I think ideally, you know, from your advice of what an investor should do when I'm looking at those two options, and I don't need 1,000 rupees coming into my bank account because it doesn't technically make a difference to us, should we then just all blanket go for the growth option?
Yeah, I mean, if you have that time horizon, and yeah, definitely. But if you're in a liquid fund, it might not be the best option. So again, it depends from fund to fund. As a thumb rule, I think the growth option in equity can do fantastic things. I think the option in debt has to be carefully watched as to when you need the money, how long your investment horizon is, and most importantly, what your tax slab is.
All right, so there's another advantage there to investing in mutual funds, the growth option or the dividend reinvestment option. Simple thing to take away from our discussion right now, if you're a long-term equity investor in a mutual fund, always use the growth option. Don't even bother looking at the other options. Take a quick break. We come back, we'll talk a little more about mutual funds. Don't go anywhere. Welcome back. You're watching the UTI Swatantra series powered by ET Now. Thank you for staying with us. We're talking about investing in mutual funds. We had quite an active conversation going when we went into break. We have a few more questions. Go ahead.
I have my financial goals in my life. When I turn to various asset management companies, I get a diversity of perspectives. I get confused in the whole process. So I need to ask as to how to decide a proper product over a definite time horizon which I look at.
So I think probably you should look at, if it's a longer term horizon, then as we rightly said, you know, an equity fund, within that you can see the pedigree of the fund manager and the fund house and the past performance, and see the risk return on the risk and the return, the weighted average on that, and then take a call as to where you would like to invest. Don't try and put all eggs in one basket. Spread it out also, so that you have some equity funds, some balance funds, depending on your risk horizon, so that you have a diversified portfolio.
Yeah, Anand, I also want you to answer this question for him because you're a distributor. A lot of times, especially senior citizens who have their corpus in their either their bank accounts or fixed deposits, they receive a lot of phone calls from distributors who give them conflicting advice saying either do this or do that, you'll get this sort of return, you'll get that sort of return. If I'm sitting on this end of the table, how do I decide, listening to that person, that okay, this person's giving me good advice, I should trust this person or I should go ahead and take his advice?
Well, it's like selecting your family doctor, you know, it's you just don't go to any clinic.
You don't know a bad decision unless it's too late.
So I think it's very important you find someone you trust and someone who really understands you, because as he rightly said, you know, you might be 82 years old and say, I don't want equity, but someone who knows you will understand your risk appetite, what your goals are, when you need to reach those goals, and also your lifestyle. I think a lifestyle is very important, you know. You like certain things, you don't like certain things. So a person who really understands you will be the best person to account for all those requirements that might come out. So I think trust is the key, and don't just go blindly to anyone.
On average, what should I be willing to pay to an advisor?
So that's a very, very interesting question, because there's a whole change, as you know, in terms of advisors wanting clients to pay. There's a whole conflict out there. So I don't think as a market we've matured to the fact that you're going to pay me a fee. Will it happen in the future? I don't know. Is it the best option? I don't know. So I think it just depends on how much. Let me ask you, how much are you comfortable paying your lawyer? You know, that's up to you to decide. You have a wide variety of options to go to, but sometimes you don't want to go to the cheapest option. You want to go to maybe someone who's slightly more expensive and gives you what you need, you know.
Do you have any more questions, sir?
But you talked about element of trust, huh?
Right.
But that is known only after there is either betrayal or we are successful. Huh?
So no, I think it's there are ways to start.
Actually,
you know,
would you recommend that you start someone off with a small amount of money?
Exactly.
For a year or so, see how you feel about the person, and then actually give them a serious amount of money.
So I think even a small thing like an SIP is the best way to you know, test a distributor or an advisor, because it's a small amount going out every month. You don't really need active advice on how to manage an SIP. And if you want to be ultra cautious, do an SIP in a liquid fund, see how that advisor or distributor interacts with you, and then maybe after a year take your call. And a mutual fund's a beautiful thing. You don't really need the advisor to carry it on with you. You can just take it and go.
Like we talked about, there are so many different variants of mutual funds in the market, and then there are various companies offering those mutual funds. So, Ganesh, you go first. If I'm actually looking at that entire list, how do I choose a mutual fund? So let's assume we're talking about equity mutual funds. How do I choose an equity mutual fund?
Yeah, again, it depends on the risk. Even in equity, there will be a large cap, there will be a small cap, there will be a mid cap, there will be a sector fund like an infotech fund or an MNC fund. But if you're a very cautious investor, and you know, then probably you should look at the safer funds within them, the balance fund category or the MNC categories, because these are less volatile and they're less riskier than the aggressive funds or the large cap. What typically we do is we want to get a better return and we get into the mid cap space or the small cap space, because that is what is exciting. But that is not actually what you really want. So one needs to be a little more cautious while selecting funds and do a little bit of research before you do that.
All right, I want to take another question. Yes, go ahead.
Is there any necessity to have formal education before venturing into investment?
I think anything that you do, when you're buying clothes also, I'm sure you do a lot of research before you do that. You just don't go and buy anything, right? So I would sincerely say one should read up a little bit on the newspaper, watch some articles, read up on matter before you really do it. We all do that. Even when you want to cook something, I'm sure you go through a cookery show, a book, article, and then go and cook, right? Similar, apply the same thing for investments. Trust me, it's not that difficult. We have a mental block in India. Majority people feel, oh, we don't understand that, so never look at it. Don't do that. I think get out of that block, try and read up a little, see what is happening around you, try and test it in a small way, and then probably go in a larger way.
You know, we're very fortunate to be living in the age of the internet, where there's so much information available to you in all forms. So There are, I know, these little cartoon videos that will explain to you how the equity market works on, on YouTube. There are articles, there are websites. All of the information is available. It's just a question of starting at some point and becoming familiar. All right, unfortunately, we've run out of time on this show. All right, so if you'd like to join us in the studio or send out a question, join us on our website, beswatantra.com, or you can tweet out a question, #Swatantra. It'll be our pleasure to hear from you. Gentlemen, thank you so much for joining us in the studio, and you've been a wonderful audience. It's been a pleasure to spend time with you. Thank you so much for watching.
Brought to you by UTI Mutual Fund. हक एक बेहतर जिंदगी का.
Mutual fund investments are subject to market risks. Read all the scheme-related documents carefully.